Yes, David, Divo is officially my favorite dividend ETF on the market. I've been doing a ton of research into dividend assets recently. I made a video on Jepi and how I'm changing my stance on it because of a few key metrics that are very important to me. Definitely check out that video for all the details. But I've come to realize that I think Divo is my absolute favorite dividend asset, and that's what I want to go over in this video. I'm going to give my stance on it, and then I'm going to take a dive into this article so we get an outside, unbiased opinion, because my opinion is extremely biased. Now, I'm not defensive of any of my assets. I would love for one of you guys to recommend a better ETF in the comments below. If I found something better than Divo, I would be enthusiastic about it because this is such a great asset. But so far, this is the best one I've found. Okay, let's get started, but before we do that, I want to say go ahead and subscribe so that way you don't lose the channel to the whims of the YouTube algorithm. And also, this is going to be quite technical, so get ready for that mentally, and let's jump into it. Okay, so first let's get the negatives out of the way. And there's really only one, and that's in terms of total return. This is over the past 3 years versus the S&P 500. It does lag the market by a slight margin. And that's why if I could only invest in one ETF, it'll be the S&P 500. It wouldn't be Divo. But luckily we don't have such extreme parameters. So the way I use Divo is I have both extremely volatile high growth assets, and then I have my compounding machines, aka my dividend growth assets. And in my growth assets, I have extremely volatile names like ARK and WCLD. In fact, we can come back to this and introduce WCLD. So for context, this is WCLD in the yellow, and it is extremely volatile. So when markets go up, because of this side of my portfolio, I will participate in lots of the gains, and it's going to make up for the small shortcomings in Divo. The major downside of this ETF is that it often has major crashes when Divo and the market don't. So even though Divo tends to slightly underperform the market, because the way I use it, I don't just invest in dividend assets, I'm okay. I have high growth, high volatility assets that offset it pretty well. But as we just saw, these growth assets can be extremely volatile and they're super dependent on what the market is doing. And that's not a great spot to always be because the market can be irrational for long periods of time. And my dividend growth assets in comparison, I view these as independent compounding machines. Of course, the market still affects them, but most of these holdings are stable, large, blue chip companies that have very consistent and reliable revenue streams. So we could be having something like, I don't know, a global pandemic, and Home Depot and United Health Group are going to continue to do just fine. Looking at Home Depot, their stock price might fluctuate a little bit, but the most important thing here is the dividend CAGR and the internal compounding machine, and this is set by management. So as long as they have the money, this machine is going to continue, and this is where the power of dividend growth investing comes from. Looking at the CAGR of Home Depot, it's roughly 20%, and this is the manifestation of that. In 2010, they paid out less than $1 in dividends, and in 2020, a short 10 years later, $6 per share. So that's what I mean by this side of my portfolio is a rather insulated internal compounding machine. And so far, Divo is the best ETF that follows this strategy that I have ever found. The single most important thing when looking at ETFs, how do they function? You don't just want to look at historical performance and pick ones that went up the most. That doesn't make you a good investor. Divo is managed with a strong emphasis on owning high quality, large cap companies with historical dividend and earnings growth to support a growing dividend. Divo is relatively balanced amongst the traditional 10 S&P 500 sectors. Divo consists of 20 to 25 stocks which are screened and adjusted according to their attributes, including market cap, management track record, earnings, cash flow, and return on equity. I like all of this. And lastly, this is what's special with Divo versus SCHD, which by the way, SCHD is a great asset also. As I talked about in my previous video on Jepi, I'm waiting for this asset to be transferred into my cash storage, and I will be introducing SCHD into the dividend side of my portfolio. But Divo just has this extra special sauce, which is tactical covered call writing. So covered call options are written on individual stocks on a tactical basis, not an index approach. So that'll be something like QYLD, which I'm not a fan of. But that mixture of having quality companies that have high dividend growth rates and some tactical cover call writing on top of it is what makes Divo so unique. But if you don't believe me, let's go over this article. And it's titled Divo, Actively Managed Dividend ETF, Blue Chip Holdings, 4.8% Dividend Yield, and Double-Digit Dividend Growth. And I got a few highlighted segments that I want to go through with you guys. So Divo focuses on companies like Microsoft, Apple, Johnson & Johnson. These are all large, high-quality blue chip holdings with strong, proven business models and diversified, resilient revenue streams and financials. Divo's holdings are about as safe as equities can be, so expect comparatively consistent returns and lower losses during downturns. These two graphs here show how Divo performed versus the market during some downturns. And it's not a huge difference, but it definitely is slightly more insulated. On a more negative note, the fund has moderately underperformed since inception. Divo underperformed because dividend equities did too, and because selling covered calls has been an unsuccessful strategy since the fund's inception. And it's referencing that capital gains have been very high over the past few years. And this is an illustration of that. Divo is purple, the market is orange, and then down here are covered call ETFs and traditional high dividend ETFs. So Divo has definitely done better than both of these, but as we saw, it is slightly behind the market. And that is a downside of this ETF. And that's why I use it the way that I use it, in conjunction with high volatility assets. Divo's higher dividend yield is a strong benefit for the fund and its shareholders, directly boosts returns, and is particularly important for income investors. The fact that the fund's holdings are quite safe is important too. Extremely few funds offer yields in the 4 to 5% range and safe blue chip holdings. Divo offers both. Now, as somebody that really focuses on dividend growth, this is my favorite thing about Divo. So this section is about the double-digit dividend annual growth track record. So Divo's dividend yield is quite strong, but the fund's dividend growth track record is even stronger. The fund's dividend has grown at a double-digit annualized rate since inception. The growth seems to be accelerating, with the fund's dividend growing by 17% over the past 12 months. Growth is generally above average for the industry and its peers, although dividends do fluctuate month to month, and that's because the covered call aspect of this ETF. Divo's strong dividend yield and dividend growth track record means that long-term investors, which I am, should see extremely strong dividends after a couple of years, and this is the whole yield on cost compounding effect of these assets. So as an example, Divo's 5-year yield on cost stands at 7%, a very strong figure. Investors should expect double-digit dividend yields in around a decade. These are strong figures and much stronger than those of its peers. And those are all the reasons why I love Divo as an ETF. It's very similar to Schd, focusing on blue chip dividend growth companies, but it has tactical covered call writing on top of it, which does limit growth somewhat, but it allows the ETF to have a starting dividend yield of close to 5%, along with the double-digit annual growth rate in that dividend, which over the long term, if you give it time to compound, will give you an insane yield on cost. That's why I focus on dividend growth so much in my portfolio. So AMT, for example, it has a very resilient business model. It's a REIT, which means their growing revenue can support a growing dividend over time. And their dividend has been growing by 20% per year. And if you do the math on that, if you put $10,000 into AMT and let it sit for 10 years, you're going to get immense payouts. And that's largely regardless of what's happening with the stock price, because these are internal compounding machines that's set by management as long as it can maintain its income. And with blue chip companies, that's usually the case. As I mentioned in the beginning of this video, I'm not defensive of any of these investments. I'm very open-minded. And if you guys can show me an ETF that's better than Divo, it would make my day. But so far, Divo is the best dividend ETF I've found. It lags a little bit on total return, but as long as you're not a purist and you also have some growth plays, it's a very nice asset to own. If you guys are still watching and enjoyed the video, give it a like, subscribe to the channel, all that YouTube stuff, and I'll see you in the next one.